There's a famous quote from Ronald Reagan that often mentioned trust but verify. I would like to flip that and say verify but trust. Measure twice, cut once. Because as investors, I think we have responsibility towards our own funds and money. And I wish I could tell people there is an easy button and you could be fully passive, but there's no such thing as being fully passive. There's a lot of work that happens up front.
Hi, folks. My name is Akash Jain. I'm your host for the Generational Wealth Show. Today, I have Vessi with me. She comes from the sunny California. Hi, Vessi. Welcome to the show.
Hi Akash, thank you so much for having me as a guest, and I really look forward to our discussion today.
Thank you. No, I'm very excited for our discussion. We have a great agenda plan for you folks. And right out of the gates, let me ask Vessi to introduce herself to all of you, as well as her background and some of the stuff that she's done in the investing world.
Absolutely happy to share. I'm originally from Bulgaria, actually grew up behind the Iron Curtain at a very different time, a very different place. But that is also when, as I reflect back on my journey, when the seed of real estate in me was planted, and I'm a full time real estate investor today. But like many, I followed the traditional path. It was always my dream to come to America or the United States, and academics was really the only way that was going to be possible for me. So I came here many years ago. I studied hard and I earned a full scholarship, and then I kind of followed the traditional path of going to school, getting good grades, getting a corporate job, and starting to climb that corporate ladder. And a few years into that journey, I realized I was climbing the wrong ladder. There were a few events of adversity that happened. Some you probably remember, such as the global financial crisis. There was the Enron scandal, a lot of corporate restructures with my own employer that unfortunately left a lot of people without jobs and in some cases retirement portfolios. And as I reflected on that, I thought, well, I don't control restructures, I don't control the markets and corporate events. What can I do to own my own destiny? And if God forbid something like that happens to me, right, I don't want to be in my 60s with my portfolio decimated by the stock market or my employer letting me go. And so that's when I think the seed of real estate germinated, and I started investing initially with single family homes, duplexes, small multis, and now I focus on multifamily. My full time job was a commercial lender, former commercial lender turned real estate investor. And about a year and a half ago, I transitioned full time into the business. So that's what I do today, and I help other high achieving professionals and business owners diversify their portfolios through cash flowing investments in real estate.
Wow, what a story. Hey, congratulations on leaving your W 2. I think a lot of our listeners are looking to follow that path. And I must say, hey, your story is very well connected in parallel to what I've done as well, right? Hey, as an immigrant, I've been here in the US for about 30 plus years, went and got my MBA and went into corporate America, climbed the ladder, some very similar stuff, if you may.
Mm-hmm.
So, a lot of us have gone through the similar path, did single family, did other asset classes, so on and so forth. So, very familiar story to myself. I can draw a lot of parallels to that. Firstly, we are in choppy waters right now.
Mm-hmm.
When I say that with the interest rates at their not coming down at high
Mm-hmm.
levels,
Mm-hmm.
what are you seeing in the market today? How are you making sense of the deals?
Mm-hmm.
How are you placed in 2025? You're already 4.5 months into it. What do you
Mm-hmm.
see coming?
Very good question. One that I think about every day because we're definitely in turbulent waters with the geopolitical events, the market events. You mentioned interest rates. So there's definitely a lot going on. And in periods of high volatility, and frankly, at any point of time, I think it is important to take a step back, discern the core from the noise, and really adhere to fundamentals, leave the emotions aside. As investors, we like to do deals, we like to get deals done. And there's a lot of temptation to jump into deals, especially because valuations have come down, in some cases 20 to 30% from the peak of 2022. But just because the price is down 20 to 30% doesn't mean the deal is priced right, because cap rates are still elevated and they tend to follow interest rate. They're not necessarily driven by interest rate, but interest rate is a big factor that determines the cap rate. And so as a result of that, a lot of sellers who are looking to exit still trying to exit at cap rates that they underwrote to a couple of years ago, and in some cases that doesn't mean the deal is priced right. And so when I review deals today, there are a few things that I look at. I'm noticing a trend where operators are eager, right, to get the deal done, and maybe they have a different outlook on rates. Mine very much aligns with yours, meaning higher for longer. And a lot of that is based on the data that I like to look at, like the long term treasury trend, loan spreads historically, and then kind of back into where I think long term rates will be, which then drives mortgage rates, which then drives where cap rates may be, particularly for investors who are looking to buy deals at positive leverage. But I understand that not everyone aligns with my worldview. So I see a lot of operators who do think that rates will collapse pretty significantly in the next 2 to 3 years. And that's how they're underwriting deals, with very severe cap rate compression. Personally, I don't like to speculate, which is why I made the comment, let's adhere to fundamentals. I would like to plan for the worst and hope for the best, which is why when I evaluate deals today, I am still looking for that cap rate expansion. I'm not talking about huge expansion, because I do believe we're at a peak rate situation, and rates may fall down, but not drastically or substantially, unless we have a very severe economic recession. And while I do still believe recession is in the cards based on leading economic indicators that I follow, there are also a lot of arguments or counter arguments to suggest it's not going to be like the global financial crisis we experienced, or the dip that was induced by COVID. So there may be some rate compression, but not significant one. So that's point number one. Point number two is strong balance sheet is imperative during periods of volatility. So one thing I look at is how is the deal capitalized. Of course, some of that comes from the debt that the lender lends or loans to the borrower. Some of it comes from investors, that's the equity. And part of that equity is used to build reserves for the property. See a very healthy reserve bucket. And for value add projects where there is some construction component involved, I'd like to see adequate cushion and really understand how the operator is planning out the capex project, given not only the cost constraints that are emerging as a result of some of the tariff fluctuations, but also the potential supply chain disruptions. So I'd like to understand how they're planning on that. I still see a lot of deals with very minimal or no reserves. Again, that worries me, because it's not a matter of if, but when unexpected things happen. Most deals that we do in the private markets tend to have 5 to 7 year hold. So a lot of things could happen over that 5 year period, and reserves provide adequate cushion for that. And then last but not least, I like to ensure the assumptions in terms of rents and expenses are realistic. We are still seeing some rent compression in certain markets. I do think that will change, because a lot of the supply that flooded the market over the past year and that is coming on board this year is being absorbed very strongly. So I do think that trend will be changing in many markets over the next 18 months and onward. But in the short run, there's still some fluctuations. So very much like to account for these events that are happening when I evaluate the numbers presented to me. And I still feel like there is a lot of enthusiasm out there, at least in the deals that I've seen to date, where people are either tweaking the cap rates, maybe taking out reserves so they can force the deal into a certain return profile that's appealing to investors, but inherently comes with higher risk, in my view.
When you started talking about fundamentals, that was music to my ears. I also adhere to the same principles, right?
Mhm.
Buy right, finance right, manage right.
Right.
I think these days, like you said, we're seeing that 20 to 30% dip in the market. So the deals are there, but like you
Mhm.
said, the cap rates are also there. Cap rates
Mhm.
are, sellers are not going down the cap rates. They're wanting
Mhm.
them. So there's still a differential between the buy price and the sell price. Are you mostly investing only oil real estate? Are you also diversifying yourself in oil and gas, startups, or any other asset classes?
I invest both actively and passively. On the active side is where I curate deals for people in my investment community. And so I've made a decision to specialize in stable value add multifamily apartments because I believe that that is how I serve my investors the best, meaning being an expert in one particular area. To the extent they want to diversify their portfolios in other asset classes, I can always introduce them to other colleagues in the space. On the passive side is where I take maybe slightly higher risk approach, where I dip my toes into other asset classes, other business plans, because that's how I diversify my own overall real estate portfolio. So then I wouldn't be 100% in stable value add apartments in landlord friendly states. In terms of my passive portfolio, though, every time I venture into another asset class or slightly different business plan, it hasn't worked out well. So I'm exploring that very, very carefully. So I would say primarily my portfolio is currently concentrated in apartments, primarily in stable value add deals. I do have one new construction project, but again, that's on the passive side, not on the active side.
So, what does your buy box look like? Is it all over the US? Is it concentrated in a few Sun Belt states? What kind of vintage are you looking
Mhm.
at? Give us some idea about your buy box.
Very specific buy box. I typically look at class, preferably class B. I would entertain C plus apartments, stable value add, meaning not a very heavy construction component. Interior, exterior updates are relatively minor. I do want the deal to cash flow on day one because for me that's one form of risk mitigation that protects the principal and the investment. In terms of, I want the deal to have positive leverage, which is another indicator of cash flow, and break even occupancy, ideally in the 70 percentile, but no more than 80%, because again, that provides me with that cushion. And in terms of location, currently my syndications are in Georgia, and that has worked well. I am looking to diversify in other business friendly, landlord friendly states because, again, the regulatory risk when we enter into deals, right? There are a lot of risks that we are taking on, and that's not one I can easily control, meaning regulatory. So I'm choosing to do business in those locations to protect my investors.
A lot of my deals are in the Dallas Fort Worth area. And again, the reason being, hey, I know Dallas. I can go touch, feel, smell my deals, and I can walk them anytime I want to. I can go
Mhm.
surprise visit to my properties. On the technology side, lately, I think we've been hearing a lot about AI and AI helping us from an investment perspective. I'm sure you're using some of it from your marketing in your marketing areas. Give us your take on technology, AI, how it's going to change some of the investments that we look at or investment behavior of some of your
Mhm.
investors as well.
Mhm.
Talk to us a little bit about AI and how you're using it in your current portfolio.
Definitely learning how to embrace it because that is the future, right? Just like we had the industrial revolution, the internet revolution, I think that's the next big leap and it's here to stay. With that said, I wouldn't categorize myself as a far advanced techie, so to speak, but I am utilizing a few tools, one being Chat GPT for idea generation or ways to repurpose existing content that I've already produced. So from that perspective, it's extremely helpful to primarily save me time, right? Because a lot of the content is already there, or maybe I have a few initial ideas, but I need some help crystallizing that. It's a huge time saving factor from that perspective. I recently learned about that was relatively new to me, maybe not new for everyone in the audience, but I heard about Opus Clip, which is a way to repurpose existing videos. And I have a ton of video content that I've created, but it creates short form videos. And a lot of that is time saving factor with tools like ChatGPT. I think Claude is another example. I haven't necessarily used Claude, where you can literally feed it information and index, and it can literally summarize those for you. Although I haven't tried it myself, and I always want to make sure the output is accurate and you're not just taking it verbatim. But that may be a tool where I can see being helpful for passive investors to overwhelm some of the confusion or maybe the data overload that they may be experienced. And then on the underwriting side, I've tested different platforms. The one I like the best is Cashflow Portal. They do have an underwriting feature that parses out the T12, the rent roll, does a lot of the analytical work that you can do today yourself. But again, it's more of a time saving factor, or possibly work that you would pay an assistant or an analyst to do. Now you can literally upload that document into the rent roll and the T12 into the platform, and it pretty much does the preliminary underwriting for you to save you time. And again, I could see that being used both by active and passive investors. So these are just a few that I have been using or experimenting with that I found very helpful. I'm sure there are a lot more AI tools out there. That's what's worked for me.
That's great. A lot of us are learning how to adapt to the new technology world. I call it the intelligence space, if you may. Are you also an operator, or are you mostly working with the seasoned operators and bringing capital to them?
I've decided to focus on capital allocation. In my prior job, I was vetting borrowers and deals, so now I vet operators and deals. So I think my prior experience and interest and highest and best use of my time is really served best in that area. So when I first started, I was operating, started with a small 11 unit joint venture, but I'm in the process of exiting that so I can fully focus on capital allocation, finding strong operators, and then connecting my investors to those opportunities.
Focusing on what you know well and what you can focus on well. That's awesome as well. Now, another question, hey, these days we hear a lot of noise around, hey, syndication versus joint ventures versus a fund approach or a fund of funds. What kind of vehicle are you using with your investors? Is it blind pool fund or property specific syndication? How do you navigate those waters?
So to date, I've been using individual property specific syndications, but it's interesting that you mentioned the fund because that is the next stage that I'm looking to transition to. Currently, actually, in discussions with my investors so we can determine, or rather, I can determine what their interest level is because, again, I'm only creating that to serve them in the best and most efficient manner possible. So I haven't made the decision whether I'll go the blind pool fund route or the flex fund route. There are pros and cons, right, to each scenario, but I do see a lot of benefit, particularly given my focus on capital allocation, to transition to a fund model so I can scale better and then serve my investors better.
Excellent. That's very understandable. And thank you for a lot of that. Now, hey, before we end our conversation here, any words of wisdom for our investors? What are the things they should be looking at before they put in their hard earned money into somebody's hand, into your hand, into my hand, into any of the operators or sponsors' hands? Any words of advice, wisdom that you could give them?
I know there's a famous quote from Ronald Reagan is often mentioned trust but verify. I would like to flip that and say verify but trust. Measure twice, cut once. Because as investors, and I'm a passive investor as well, I think, or my view is that we have fiduciary responsibility towards our own funds and money, right? And I wish I could tell people there is an easy button and there you could be fully passive, but there's no such thing as being fully passive. There's a lot of work that happens up from a due diligence perspective that is extremely important for passive investors to do, starting with vetting the operator and or fund manager that they're investing with, vetting the market and sub-market of where the deal is located, and then of course vetting the numbers. And you don't have to be an expert on all of these things. There are so many resources, groups out there that you can join to learn about each of this aspect. And the more you do it, the more deals you review, you get more comfortable and more efficient, more effective with that diligence process. But definitely measure twice, cut once would be my advice before investing in a deal, because any investment, right, comes with inherent risks, and real estate is not foreign to that concept, but it also can be very rewarding when it's done right, well thought through, and well calculated.
No, those are some great words of wisdom. Hey, obviously there is no free lunch. There is every deal is inherent with risks. So look at it again, and then press the button. There's no easy button. That's great. Vessi, thank you so much for being on the show. I sincerely appreciate it. I'm sure our viewers will love it. And thanks a lot. Have a great day.
Absolutely. Thanks so much, Akash.
Thanks. Bye.